Welcome! Got another episode about the stock market. Is it overvalued? A lot of people seem to think so. They look at the high prices of stocks compared to their earnings. They look at the recent run-up of the stock market, just going up and up and up. They also look at the speculative behavior, the amount of IPOs that have been issued, and the amount of option and individual stock trading that people are doing. All signs of excess, signs of a bubble. And therefore, people think because the market's going up and up and up, that it's going to crash. It's interesting. So let's take a look at that. We'll go through and take a look at different indicators, see what they tell us about the market, whether it's overvalued, and so we can make a conclusion on our own. Now is a great time to like or subscribe. I could really use your help, and hitting the like button will help the YouTube algorithm find better videos for you. The younger generation seems to be really in tune with the market. After all, they've lived through the Great Recession, they saw the stock market plummet, and they've experienced firsthand how difficult it was to get a job during the Great Financial Crisis. They've also been great investors during the last stock market crash, investing pretty aggressively at the bottom. And we know this because we could look at trading activity from new trading apps. Let's take a look. We can look at the investing app Robinhood, saw record deposits in the first quarter of 2020 with daily trades up 300% compared to late 2019. Elsewhere, eToro and Raging Bull saw demand surge 220% over the same period. I think these investors are pretty savvy, and they know a bear market happens every 4 years and 8 months. That's about twice a decade. And these savvy investors are invested in individual securities or using options to help leverage their gains, which is pretty risky. And I think they know that. So they're always on the lookout for when is the market going to crash, because that's going to bring down all these bets that I've made. You know, my leverage that I might have in margin or in options might fall apart as well. So they're always on the lookout for that. So that's why this is important to go over sort of the macro view of the markets. Are they overvalued or not? And so let's go take a look. So the first one that we're going to take a look at is the price to earnings ratio. And the price to earnings ratio is the price of the stock, right, divided by its earnings. And so a high price to earnings ratio means that the stock is very expensive compared to how much money it's actually making. And so over time, people have looked at where are we relative to the past? Are we below average in terms of price to earnings or above average in terms of price to earnings? And then how far above average? When the price to earnings ratio gets really high, then people start to worry and think that the market's overvalued. So let's take a look. So I'll throw a chart up here so you can see it. But right now we are way above average for price to earnings. We just popped over 2 standard deviations from the historical norm on price to average, going back to 1950 for the S&P 500. So S&P 500 since 1950, price to earnings ratio way overvalued. We're 2 standard deviations off, which means a lot. But then if you take a look at what they call the modern era, like since 2000, we don't look so overvalued. And that's a conundrum with the price to earnings ratio. You see, if you take a really far look back, say since 1950 of the S&P 500, price to earnings ratios have looked really bad for a long time. But if you just start at 2000 and look at price to earnings ratios, they don't look as bad. So why did that happen? What's going on? Well, some accounting experts are surmising that there's changes to accounting rules and people weren't reporting as many earnings as before because the GAAP earnings got much harder to report some earnings that they were reporting before, so that made it more difficult. But another thing to keep in mind is that companies can manipulate their price to earnings ratios. You know, higher price to earnings ratio is better, right? More earnings for your stock is better, right? And what they can do this by buying up shares on the market. So if you take a look at the number of outstanding shares in the S&P 500, you see it going down over time. And that means that companies in the S&P 500 are buying up shares off of the market, so there's fewer shares available. And when there's fewer shares available, that divisor of the market cap gets smaller. So those outstanding shares multiplied by the price, that gets smaller over time. And because it gets smaller, it makes the price to earnings ratio look higher. And so that, in my opinion, is what has been happening. Companies have been buying up stock. The reason they've been buying up stock is for two things. First, you have low interest rates that have been going down over time. And then also more recently, you have the tax cuts, the corporate tax cuts, which companies tended to have historically tended to pour back into buybacks of their shares. Okay, for our next indicator we're going to look at the gross domestic product compared to the market cap for the Wilshire 5000. So the Wilshire 5000 are the largest 5,000 companies listed on public exchanges. So it doesn't include private equity. And what you do is you compare the total market capitalization. That means all the price, all the shares out there, add them all up, and you compare that to the gross domestic product of the United States. And historically, all the shares added up together in the Wilshire 5000 have been less than the GDP of the United States. And this kind of makes sense because if these are U.S. companies, they're making money from the U.S., and so they can't be any bigger than the U.S., right? And so this is also famously called the Buffett metric, where Warren Buffett says that, hey, if the Wilshire 5000 market cap is bigger than the gross domestic product of the United States, then stocks are overvalued because clearly there can't be more money in those 5,000 stocks than there are in all of the United States. Well, there's some flaws with this measure as well. First of all, a lot of big companies make money all around the world, right? Like Microsoft and Apple, they sell gadgets and gizmos all over. They get all that money and it comes back into the United States, or even if it doesn't come back in the United States, it's part of their market valuation, right? They can have billions of dollars in cash in Ireland and that will still be on their balance sheet and it will still be part of valuing the company. The second thing is it doesn't include all the private equity, all the venture capital companies, all those. So we don't know what that's looked like historically either, so we're missing a big chunk of that puzzle. And so if we saw the whole picture, it might be more frightening, right? Or it might be less, don't know. Also, you have to look at foreign investment. So are foreigners investing in the United States? Because if they are, that would also pump up these investment assets. So for example, if you're living in another country and you look at the United States and say, wow, its interest rate is way better than my country has a negative interest rate, I'm going to go buy U.S. equities, U.S. utilities, U.S. bonds, right? Because the U.S. dollar is strong and because the interest rate isn't negative, I like it better, I'm going to do that. So foreigners putting money into the United States would also pump up these valuations. Comparing it to the GDP of the United States may not make sense. You may have to compare it to some fraction of the GDP, of the world GDP. Pretty interesting though. But right now it says overvalued. Okay, now we're going to take a look at interest rates. So interest rates and stock market, how are they related, right? Complicated. We'll go into whether there's a strong link or not. But if you look at this chart, you'll see that as interest rates go down, the stock market goes up. And as interest rates go up, the stock market goes down, right? And the theory is that the money from these interest rates dropping makes it easier for companies to earn money. So specifically, it's about the cost of goods and being able to acquire new customers. So as interest rates drop, you can borrow money for cheap. And because you can borrow money for cheaper than you used to, you can use it to acquire customers for cheaper than you used to, right? So more advertising, more free products, more, growing and expanding into new regions. For all those reasons, interest rates drop, money is cheaper, you can acquire new customers and you can grow your earnings, right? That's the theory. I guess, in modern finance, you'd also have the theory that because interest rates are dropping and money is cheap, you can buy back your stock, right? So a company can buy back its own stock. This makes a lot of sense if you're paying a dividend. So if you're paying like a 3% dividend on your stock and the interest rate drops to 1%, you're like, wow, I can borrow money for 1%. use it to buy back my own shares, which I'm paying a 3% dividend on, and then never have to pay that dividend again, wow, this almost pays for itself. And so when interest rates are really low, companies do find it makes financial sense to borrow at really low rates and buy back their stocks so they don't have to pay their dividends. And so that can also force stocks to go up as interest rates drop. So that's the theory, and you see these two lines diverge. So when interest rates go down, stocks go up. When stocks go up, interest rates go down. That's the theory, at least. I think this one is really tough to find a strong direct linkage to, right? It's all these sort of indirect causalities. You'd really have to drill down a lot to say, yeah, people are definitely acquiring new customers. They're definitely growing their profits because they're borrowing more money and using it to acquire customers, right? You'd really have to do that. Or the inverse, right? Certainly if interest rates are going up, now it's harder to acquire customers, you'd have to have a really low-cost way of acquiring customers. So, for example, if you had to go out on, if you're like a condo salesman, right, and you had to go out and offer free dinners and stuff like that in order to get people to come to your condo showing so you could sell your condo, right, as interest rate goes up, those free dinners, that cost of acquisition for customers are getting much more expensive, really hard. Whereas if you look at a company like Microsoft, right, it's software, right, licenses are really easy to acquire. Hey, you want another license? Sure, just go ahead and add it. We have self-service software, you can just do that yourself. The cost to acquire customers is really low, so as interest rates go up, those companies like Microsoft should perform better because they continue to grow even under this inflationary pressure, while the condo salesman not able to grow because they can't do as many of these dinners. They have to have a really high success ratio, otherwise it's not going to be worth it for them to put out money for these events to try to get new customers in the door. So I think there's a really sort of tenuous link between interest rates going up or interest rates going down and the stock market. It may be true, but you can also see it's not perfectly correlated from this graph. It goes up and comes down, it goes up and sideways, and it doesn't always match. But right now, if you look at this one indicator, it's saying that the stock market is fairly valued, which is interesting. Okay, so the last thing we're going to take a look at is speculative behavior. Really hard to measure that, so what we're going to look at is the number of IPOs by year. So if there's more IPOs, that then means there's more people taking a risk on the stock market, being good, so that they're going to go public so they can get a high valuation so they can make some money. If they think that the market is bad or they're in a downturn, they're not going to go public because there's nobody that's going to buy their shares of their new company. So we'll take a look at this video here. And you can see in 1999 and 2000, right, over 400 IPOs, and then in 2002, when the market crashes, we go down to 104 IPOs. Next, you see the activity spike up again in 2007 and 2008 and 2009 it drops down, and then just in 2020 we pushed back up to 407 IPOs for the year of 2020. So 407 IPOs is a lot that beats some of the historical norms, but that doesn't mean a crash is coming anytime soon, because if you look at 2000 and 2001, you see you had 2 years in a row of these high IPO levels. So we could have 2021 being even a bigger year than 2020, having even more IPOs in it. And we're off to a great start this year with all the IPOs, including all the special purpose acquisition companies that have been formed. Those are publicly traded companies as well that are starting out and emerging and bringing new companies in to the publicly traded markets. So yeah, things do look pretty overvalued from speculative behavior in 2020, but that doesn't mean the party's going to stop anytime soon. After all, a bull market's not going to die from old age, it always dies from some other shock. So to sum this all up, is the market overvalued? Is it going to crash anytime soon? And the answer is, nobody can really know. Nobody can really time the market that well. If they could, they'd be a genius, and we should all listen to them. There's actually a lot of people who make money pontificating and selling advice on when the stock market's going to do well and when it's going to crash. And these people more often than not are wrong, but yet they still somehow make a living on this stuff. If you look at the stock market over time, right, you'll see there's never a bad time to invest if you have a long enough time horizon. So let's take a look at the stock market and imagine that we invested at some of the peaks of the market and look at what happened over time. Okay, let's take a look at a long-term view of the stock market. All right, we are going to start out and we're going to highlight all the bear markets in red ovals here. And you see the first one in 2000 going to 2002. See the next one, the Great Financial Crisis happening in 2008, 2009. And then the last bear market we have is in 2020, a drop of more than 20%. Now let's say that you bought at the peak of the 2007. How would you be doing right now? Well, as you can see, now in 2020, compared to 2007, you would be making a lot. You've gained all this money. You've gone from basically 30, maybe 40, up to 100. That's a big gain. And let's see at the peak of the 2020, if you had bought there and held and not sold, you would have gone from about 80 up to 100. So that's a huge gain there as well, more than 20%. So you can see that even if you buy on the peaks, if you just wait a couple of years, you'll definitely do great. So there's no bad time to invest in the markets if you have a long-term view. Okay, so what are the things that you should learn from this whole presentation about is the market overvalued or not? I think macroeconomics is really tough. It doesn't dictate what's going to happen in the market. Like, you could look at the big picture. It's good to know where you are, but that doesn't mean the market's going to respect that data. In fact, markets are often irrational in the short term, but they're rational in the long term. So what should you do? How should you think about things? The first thing I would say is always put your cash to work. If you're not invested and you're holding cash off to the side because you can't time the market up or down, I think it's really going to be a disaster. So you should always be putting your cash to work. I think the second thing is, have a long-term view. If you invest now and you lose money, it's okay. 10 years from now, you'll probably do great, probably even better than great. 20 years, you're definitely going to be doing great. Let's see, I got some other points written down here. Oh, another one is be consistent, right? Invest in good times, invest in bad times. If you're consistent and you're just putting a little bit away, I think things will go really well. That's how a lot of people operate. I think it's a great way to do things. I think the last thing is, one of the last things is being diversified is consistently good. So if you're diversified in your broad index, you're consistently in a good position. If you concentrate your bets and you're investing in single equities or actively managed funds or options, then you can do spectacularly good, but you can also do spectacularly bad. So it's really hard to be consistently good if you're making these concentrated bets, but you can be consistently good if you're in a broad-based diversified index. So if you're worried about stuff, right, think about diversifying. Diversity doesn't mean your volatility is going to go away. Diversity just means that over time, right, you're going to do well, you're going to be making money. Whereas if you invest in a single company, over time, there's no guarantee you'll do well, because that company that you invested in could go out of business, and then you'd lose everything. Happened with Enron. Well, I hope this video helped give you an understanding of the economic indicators people look at to test whether a market is overvalued or not. And I hope it gave you a good understanding of what the theory is behind these economic indicators, and what are some of the things to look at for these economic indicators where they may not hold up. Again, I hope this helped, and I'll talk to you next time. Bye-bye.